Life insurance has evolved greatly over the years. Non-term life products today are more commonly called permanent life insurance to indicate that while they still provide lifelong coverage, modern product offerings go far beyond traditional whole life insurance. A common trait with all these new permanent life products is their flexibility. Some policies feature premium flexibility. Others let policy owners change the death benefit and cash value. In every instance, the result is the same. Policy owners can change their life insurance to match their changing insurance needs. Adjustable life insurance. The first of the new generation of flexible permanent life products was the adjustable life insurance policy. Adjustable life lets the policy owner request a change in the premium and, in so doing, change the policy's death benefit and future cash value growth. With adjustable life insurance, a decrease in the premium results in a decrease in the face amount, while an increase in the premium increases the face amount. Changes that increase the face amount will usually require the insured to provide evidence of insurability, but many adjustable life policy owners find this preferable to buying additional policies as their life insurance needs grow. Adjustable life premium changes do not require the insurer's permission, but insurers do require that policy owners formally request the premium change, within limits set forth in the policy. Limits apply to both the amount and the frequency, for example, once per year, at specified times, of changes. Universal life insurance. The most flexible of all types of life insurance is universal life insurance, UL. With UL the policy owner can, at any time, within certain limits, increase premiums, reduce premiums, occasionally skip a premium without the policy lapsing, increase the death benefit, subject to evidence of insurability, or decrease it with or without any change in premium. Unbundled policy components. With traditional whole life insurance, the three components of the premium, mortality charge, expense charge, and interest credit, are bundled into a fixed premium amount that remains unchanged for the life of the policy. With universal life insurance, these three components are unbundled and treated as separate amounts that can change independently over time. This unbundling is the key to UL's flexibility. UL cash values, monthly adjustments. To account for premium payments and to pay for the policy's insurance and expense costs, UL policies are adjusted monthly too. Credit the cash value with any premiums received since the previous adjustment. Credit the cash value with interest. Deduct from the cash value the cost of insurance, the mortality charge, and an expense charge. Minimum interest guarantee. AUL policy features both guaranteed and current interest rates. The guaranteed rate, typically 3 or 4%, is stated in the policy contract. The current rate, which is based on current market conditions, is credited if it is greater than the guaranteed rate. UL mortality charges. The monthly mortality charge reflects the cost of pure insurance coverage, called the net amount at risk, at that point in the policy's life. All life insurance mortality charges increase with age to reflect the insured's increasing risk of death. With traditional whole life insurance, the rising cost of insurance is offset by a steadily decreasing net amount at risk, resulting in a level mortality charge that, in turn, supports a level premium. Universal life insurance is based generally on the level premium concept, but exactly how much depends on the type of death benefit option in effect. Universal life death benefit options are covered below. Premium flexibility. Premium flexibility is a primary feature of universal life insurance. AUL policy owner can increase, decrease, or even occasionally skip a premium payment. If AUL policy's cash value covers the monthly deductions, the policy remains in force. If the cash value becomes insufficient to cover the monthly deductions, the policy lapses. A policy owner can change premiums without formal notification to, or permission by, the insurer. Premium flexibility brings with it the risk that a policy may be overfunded or underfunded. Insurers provide guidance to make sure neither happens. In general, there are 3 different premium levels, a low end, high end, and just right amount, that set AUL policy's premium range. The minimum premium is the least amount needed to cover the cost of pure UL insurance and the policy expenses. Funding a UL policy at its minimum level jeopardizes its long-term solvency. The target premium is the amount at which insurers typically pay full first-year commissions to their agents. It represents a sound middle ground for UL policy owners to follow. The guideline premium is the highest amount that can be paid for that level of death benefit and still permit the policy to meet the IRS guideline premium test, explained shortly. Key point: premium flexibility requires ownership responsibility. Reducing or skipping premiums can deplete a UL policy's cash value to the point where the policy lapses. If its cash value is enough to cover the mortality and expense charge deductions, the policy remains in force. If the cash value is insufficient to cover these monthly deductions, the policy lapses. UL death benefits. While the death benefit in most life insurance policies is referred to as the policy's face amount, with UL it is called the specified amount. The distinction is important. Face amount implies a guaranteed amount, listed on the face page of the contract, that is possible only through the payment of a fixed premium. With its flexible premium, the UL contract cannot guarantee a face amount. Instead, UL applicants specify an amount that the policy will target as a death benefit. If the policy is properly funded, the actual death benefit should equal, if not exceed, the specified amount. As with its premium, UL features flexibility in choosing the basic type of death benefit. Traditional universal life policies offer two death benefit options. Option 1, or Option A, has a level death benefit. Option 2, or Option B, has an increasing death benefit. Universal life insurance policy owners can switch death benefit options with few if any restrictions. Death benefit Option 1, level death benefit. Death benefit Option 1 resembles the policy structure of a traditional whole life policy. The specified amount generally remains level, the net amount at risk decreases over time, and the policy's cash value is part of the policy's death benefit. Death benefit Option 2, increasing death benefit. Death benefit Option 2 features an increasing death benefit that equals the policy's specified amount plus its cash value. The policy's specified amount is the net amount at risk, which remains level, like a level term policy. As the cash value increases, the death benefit increases by the same amount. If the cash value decreases, through withdrawals, the death benefit decreases by the same amount. Guideline premium test. To qualify as life insurance and thus enjoy the favorable tax status of life insurance policies must always meet a guideline premium test to make sure the policy has not been overfunded, meaning the policy's cash value has grown too big in relation to its death benefit. A life insurance policy is considered overfunded if it violates the IRS corridor requirement. Corridor requirement. To discourage people from using life insurance for tax-favored investment purposes, Congress in 1984 created a legal definition of life insurance that requires all permanent, cash value, life insurance policies to maintain a minimum amount of pure insurance protection until policy maturity. With whole life insurance that is age 120, but with UL it is age 95. UL policies must have a corridor of pure insurance protection, separating the cash value from the death benefit, so that the policy doesn't mature before age 95. The required corridor amount is expressed as a ratio between the policy's death benefit and cash value for any given age. It steadily decreases as the policy nears maturity. To prevent violating the IRS corridor requirement, UL Death Benefit Option 1 policies automatically raise the death benefit if necessary to maintain the required minimum amount at risk through policy maturity. See chart. Changing the specified amount. In addition to changing death benefit options, UL policy owners can also change the policy's specified amount. The specified amount can usually be increased with satisfactory evidence of the insured's insurability. The policy owner can, likewise, decrease the UL policy specified amount, but not so low that the policy's cash value exceeds the IRS corridor limit. Accessing UL cash values. Traditional whole life policies provide access to cash values through policy loans. While policy loans are available with universal life insurance policies, there is a section option as well. Instead of a policy loan, Policy owners who want to access some of their UL policy's cash value can do so through a withdrawal, called a partial surrender. A withdrawal reduces the UL policy's cash value as well as the current death benefit by the withdrawn amount. Unlike whole life policy loans, partial surrenders cannot be paid back. Example. To understand the difference between a policy loan and a partial surrender, consider Joan and Carl. Joan owns a whole life policy with a $100,000 face amount and a $25,000 cash value. She takes out a $5,000 policy loan and does not pay it back. When she dies 3 years later, the loan value, with interest, has grown to $6,000. The insurer deducts that loan balance from the death benefit and pays $94,000 to the beneficiary. Joan could have paid back some or all of the loan, which would have meant a larger death benefit payment to the beneficiary, possibly even the original $100,000. Carl owns a universal life policy with a $100,000 specified amount and a $25,000 cash value. He makes a $5,000 partial surrender, which reduces the specified amount to $95,000. When he dies 3 years later, the beneficiary is paid the policy's $95,000 face amount. Repaying the partial surrender and returning the specified amount to $100,000 was not an option for Carl. UL surrender charges. To cover the costs of administering a product as flexible as universal life insurance, insurers charge fees that may be assessed either as a front-end load directly from every premium payment or as a back-end surrender charge on partial or full surrenders. Front-end loads are usually a fixed amount, 1 to 3% of the premium is common, payable for the life of the policy. Policy surrender charges decline over time. For example, the surrender charge may be 10% on withdrawals during the first policy year, 9% the second year, and so on. While 10 years is common, surrender charges may extend for the first 15 policy years or longer. Back-end loaded policies are more appealing to consumers than front-end loaded policies because surrender charges are in the policy owner's control. They are avoidable by simply not surrendering any part of the policy. Indexed universal life insurance. Indexed universal life insurance ties the interest credited to the contract's cash value to an equity index instead of a rate declared by the insurer. The actual index used in these policies is usually a stock market index like the S&P 500. A few product designs are tied to a bond index. The interest credited to the policy's cash value is based on the percentage change in the associated index during the index period, usually 1 year but can be longer or shorter. For example, assume a policy is tied to the S&P 500. At the beginning of the contract's term, the S&P is at 1,200. At the end of the term, the S&P stands at 1,250, which is a 4% increase. In this case, the policy would be credited with 4% interest until the next index review. The advantage of an indexed UL policy to consumers is the potential for higher rates of return than those associated with traditional policy interest crediting. To offset the downside investment risks of the stock market, most insurers offer a guaranteed minimum interest rate such as 1%. Variable Universal Life Insurance. Variable Universal Life Insurance, VUL, combines features of variable life and universal life. Like variable life, VUL policies invest premiums in non-guaranteed sub-accounts managed by the insurer in a separate account. Also, like variable life insurance, VUL is considered both a life insurance and securities product. To sell VUL policies, an agent must hold both a state life insurance license and a FINRA securities registration. Like universal life, VUL policies feature premium flexibility. Policy owners can increase or decrease the premium and even stop payments. If the policy's cash value covers the monthly deductions for the cost of insurance and expenses, the policy stays in force. If the cash value is not sufficient to cover the monthly deductions, the policy lapses. VUL monthly deductions. As with universal life insurance, VUL unbundles the three basic premium components, interest, mortality, and expenses, and deducts the mortality and expense charges from the cash value monthly. In addition, the insurer normally deducts an investment management fee to cover the cost of managing the separate account. VUL cash value. Cash value funds allocated to the variable subaccounts are not guaranteed. Instead, subaccount values move up or down depending on the investment performance of the underlying subaccount portfolio. As with regular variable life policies, VUL policy owners can transfer funds from one variable subaccount to another within the policy without any income tax consequences. VUL death benefits. VUL policies offer the same Option 1 and Option 2 death benefits as fixed universal life insurance policies. In addition, some VUL policies offer a third option. Option 1. The death benefit is equal to the policy's specified amount and includes a decreasing net amount at risk. Option 2. The death benefit is equal to the sum of the policy's specified amount plus the cash value and includes a level net amount at risk. Option 3. The death benefit is equal to the sum of the policy's specified amount plus the greater of total premiums paid or the actual cash value. This appeals to consumers who are concerned that a drop in market values could mean the cash value is less than the sum of premiums paid. While policy owners can normally change between death benefit options 1 and 2, they are not permitted to change to or from death benefit option 3 after the policy is issued. VUL cash value access. VUL policy owners can access their policy's cash value through partial surrenders, though usually not until after the first policy year. Amounts taken from the cash value reduce the death benefit. Variable life versus VUL. Both variable life, VLI, and VUL are securities products as well as insurance products. They both let the policy owner allocate funds to investment subaccounts offered by the insurer. Both also offer a death benefit and cash values that vary based on the performance of the investments in the subaccounts. However, they are distinct from each other in the following ways. Premiums. VLI policies have a fixed, set premium payable for the life of the policy. VUL policies generally require a minimum initial premium to cover first-year costs. After that, VUL premiums are flexible. Death benefit. Under a VLI policy, the policy owner's payment of the fixed premium guarantees the policy remains in force and provides a guaranteed minimum death benefit upon the insured's death, regardless of the performance of the separate account to which premiums and cash value are allocated. In contrast, under a VUL policy, the death benefit amount is not guaranteed and may be less than the specified amount. Cash value access. VLI policies allow policy owners to access cash values through policy loans. Like other universal life insurance policies, VUL provides access to the cash value through partial surrenders. For your review. With adjustable life, a decrease in the premium will result in a decrease in the face amount, while an increase in the premium will lead to a face amount increase. UL policy flexibility is due to unbundling the premium factors of mortality, interest, and expenses. A UL policy owner can decrease or even skip premium payments. As long as a UL policy's cash value covers the monthly deductions, the policy remains in force. A withdrawal reduces the UL or VUL policy's cash value as well as the current death benefit by the withdrawn amount. UL policies have two death benefit options. Option 1. Level death benefit. Option 2. Increasing death benefit. VUL policies also have a third death benefit option, the policy's specified amount plus greater of total premiums or cash value. UL/VUL policy surrender charges are clearly spelled out in the contract and decline over time. Please pause the audio and watch the video. You can restart the audio playback at any time.
There was a day when life insurance choices were pretty simple: chocolate or vanilla, term or whole life. And that world existed pretty much until sometime around the mid-1970s. It was around that time that consumer demands for more flexibility, not only in how a policy functions, but in its investment choices, began to change the insurance world, the life insurance world as we know it. Beginning in the 1970s, we evolved a product called Universal Life Insurance. This lesson talks about Universal Life. I just want to take a few minutes to make sure you really understand what UL is all about and how it's constructed, and also help you understand the difference between option 1 and option 2. Step back a little bit and recall the conversation we had on whole life insurance, where we said whole life insurance is characterized by, if you will, generally speaking, a type of decreasing term protection called net amount at risk and an increase in cash value, which combined allows for the policy to have a level death benefit. That effectively is what Universal Life Insurance Option 1 is all about. If you look at a diagram of UL Option 1, you'll see it has a decrease in net amount at risk and an increase in cash value. It looks just like a whole life insurance policy. There's one huge difference between universal life insurance and whole life, and that is the flexibility, where whole life insurance is a bundled package where the mortality charge, the interest, credit, and the expense charge are all bundled into one single component. With universal life insurance, those charges are unbundled and, in fact, can be handled in very separate ways. The bottom line is that universal life insurance policyholders have a lot of flexibility in determining how much they want to pay into that policy. Now, we just described Universal Life Option 1. What's Universal Life Option 2? Well, if Option 1 effectively has a decreasing term policy underlying it, that is, decreasing amount at risk, Option 2 effectively has a level term policy underlying it, or literally, it has a level amount of risk throughout the life of the contract. When a universal life policy option 2 is purchased, the additional money goes to build the cash value, which actually has a result of increasing the death benefit, because the level net amount at risk with the additional cash value going on top of it yields an increasing death benefit. So when you look at at option 1 and an option 2, think of it in terms of decreasing term life insurance under option 1 and level term life insurance underlying option 2, and that will help you get a better understanding of this very popular type of life insurance.
Okay, so we have another long lesson here. A lot of information, and we got 4 questions to answer. I will probably have to go back and review this video, so if that's what you need to do before you take your test, then go ahead and do it. Variable life and variable universal are similar, except I want to say this one. They both offer a death benefit based on the performance. Both require fixed set premiums. But if it's variable, how can it be fixed? Okay, that's confusing. Kate bought a universal life policy with $200,000 death benefit and chose death benefit option 1. In year 5 of the policy, she withdrew $50,000 from the policy's cash value. If she dies shortly after withdrawing $50,000, what will her beneficiary receive? I don't know. I'm guessing 50. All right, all of the following statements about index life insurance are correct, except, so which one is wrong? There's both a whole life and universal life version of indexed. Index universal offers potential higher rates. The insured bears all the investment risk. To meet the federal definition of life insurance and qualify for life insurance favorable treatment, all permanent life insurance policies must have cash value that grows equal to the death benefit no later than the insured's life expectancy. Alright, we're going to try that. Let's see what happens. Oh, one right. Alright, both required fixed set premiums. Okay, that was my first choice, but if it says variable, how can it be fixed? But both require fixed set premiums. So both types of policies offer death benefit and cash values that are based on the performance. So I got this one right, okay? That was obvious. Man, that was almost too easy. I hope that's like the test questions. Alright, all the following about index life insurance are correct except the insured bears all the investment risk with an index life insurance policy. So this is actually wrong, but it's the right answer here. So this does not happen. Everything else is correct. So there is both a whole life and a universal life version of index life insurance, though they function in different ways. Alright, this one here, all policies must have a corridor of pure insurance protection between the cash value and the death benefit. Which depends on the insured's age. Age 120 for traditional whole life policies and 95 equal the death benefit at policy maturity age. The insured's life expectancy plays no role in this. Alright, that's the end of this lesson. I'll see you on the next one.